This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
You've got the best podcast going, Jason. I love your show, man. It's good stuff.
Oh, thank you. I really appreciate it.
What I wanted to share was my wife and I, for the first time ever, paid effectively no income tax in 2022 through doing a cost segregation study and generating about a $200,000 paper loss on our real estate. I'm a real estate professional, and it really works.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome, empowered investors, to episode 2138. And I want to start off, we've got a bunch of things to talk about today, but I want to start off just talking about the super sticky part of the inflationary cycle. And what do I mean by that? You know, there are various things that happen in the economy where prices inflate, or the money supply increases, or even more importantly in today's world, the supply of credit increases. Sort of another form of money supply, but not exactly the same. And certain things that occur are more sticky for inflation than others. Others can be much more, to use a famous phrase that we heard from our Fed chair many times over the last couple of years, transitory, right? They're not permanent. But some things that happen in the economy really cause a very permanent type of inflation. Now, of course, as investors, we really benefit from inflation as real estate investors because, of course, our assets are indexed to inflation. The ingredients of all of the houses we own, the copper wire, the glass, the steel, the lumber, the concrete, the drywall, all of those materials, the energy, and the labor cost, which I'm going to talk about in a minute, a particularly sticky component, all of those things are indexed to inflation very nicely. And at the same time, our debt is debased by inflation. So we borrow the money at today's dollars, we pay it back at the lower value of tomorrow's dollars, that beautiful thing known as inflation-induced debt destruction. It's a wonderful hidden wealth creator. So what is the future? Is it inflationary or deflationary? Or is it stagflationary or disinflationary? Does it kind of just sort of muddle along, or are we going to have a lot of inflation? Well, I say the future is very much inflationary. And here is yet one other aspect. If you're watching on video, you see this chart talking about global staff shortages. It says global staff shortages balloon in just 6 years. Share of companies affected by staff shortages in selected countries for last year. Japan, the worst, right, in terms of staff shortages. 85% of Japanese companies say they are severely affected by staffing shortages. Now, Japan has this terrible demographic problem that led to the lost decade, the lost 2 decades, and really moving into the lost 3 decades. Things have improved there, but they have a structural demographic problem because Japanese people just have not had enough children. They're trying to get it back on track before they go extinct, but we'll see how it all works out. That's another discussion for past episodes and for future episodes as well. Okay, Germany says 82% of companies staff shortages. India, 81%. You'd think that in a place like India, there would be no shortage of people. The UK, 80% of companies complaining about staff shortages. United States, right here, 70% of companies complaining about this. China, where again, you'd think there'd be no shortage of people in China. 69% of companies say they have staff shortages. Colombia, 66%, and Finland, 59%. So what does this mean? And why am I telling you this? Well, wage inflation is particularly sticky. When you look at commodity price inflation, commodities go up and down. They can change. We all saw that with construction materials. And over the past couple of years, I reported on that a lot on the show, how construction materials were way up during the pandemic. And then they softened quite a bit. Of course, still higher than they used to be, but those commodities do fluctuate quite a bit more. But wages, when you have staffing shortages and you got to pay higher wages, those are very sticky. When people's expectations get to where they are earning a certain amount of income, no matter how ridiculous or out of line their income is with reality, once they get to that certain point, they have a very, very tough time accepting lower pay in the future. So they might leave their employer, they might go to another job, but their expectations are set at a certain level, and the chance of them agreeing to much lower pay will be very unlikely. Many times they will just stay unemployed. A friend of mine was recently commenting on this. She said to me, I was laid off from my job about 6 months ago. And she said, but I don't want to take just anything. She had kind of a good deal, and she wasn't able to replace her good deal. And I have seen this over and over again in my hiring over the years. In all of the different companies I've had, I've probably hired, I don't know, I'm just guessing, 2,000 people in my career, right? And I'm always hiring. I'm never being hired, right? I'm always hiring people. And so in hiring people over the years, a couple comments. Number one, I have hired so many people with psychology degrees. They had a major in psychology. They thought it was an interesting subject in college. And with me, I've never hired a psychologist, right? I do not have a psychology business, but I've sure hired a lot of psych majors, right? Because a lot of people take these interesting things that they think are interesting. I mean, it's an interesting field, but they never use that in the career world. Another thing that I have seen over and over again, and this particularly happens with people who had a sort of peak corporate job. And now, the whole idea of the corporation from the 80s onward, downsizing, right-sizing, re-engineering, et cetera, the changing face of corporate work culture that has changed dramatically over the decades, right? We all know that. But I have seen so many people and hired so many people that had this big corporate job and they earned a lot of money. And, I'll just throw out an example. Maybe they were earning, and now you'd have to adjust this for inflation, because if I hired them 20 years ago, right, it's, you got to adjust for inflation, obviously, right? But, they might come in and tell me they were earning $200,000 a year or $250,000 a year. They had this great big corporate job, big job. And then they were laid off. Because basically what happened many times is their employer just realized that they couldn't ask them to take a pay cut. The person probably wouldn't do it. And they just got too expensive, okay? And it just wasn't worth it to the employer to have them there. And this person, who was many times in their 50s, okay, that had this big corporate job, big corporate career, did really well, they could never get back to that same level again. They started selling real estate or doing mortgages. I mean, I've hired those people many, many times, right? And they could never kind of replace and get back to the old sort of glory days, if you will. This really just shows us, I mean, I think, there's many lessons here, but one of the lessons is you cannot depend on anybody else for your financial well-being. You have to create it yourself. And I don't mean that you have to start your own business, although certainly a lot of people choose that path. But you need to have a financial sound footing of, ideally, real estate investments, income property investments that are there to back you up, that give you options, and they buy you time. Particularly one interview that I think of, and I'm sure he's listening now, is Kurt Moe, who's been on the show a few times, right? One of our clients who listened to my podcast for 9 years before ever raising his hand and saying, hey, I'm ready to invest in properties, right? You heard his story. He was on the show telling the story. He's got a great story. And what he said when he was laid off from one of his corporate jobs, right? He basically had the luxury of working out a good deal for himself for the next job, right? He wasn't under a ton of pressure because he had just a couple of properties, no big portfolio, not a giant, he didn't have 24 properties, right? He didn't have 100 properties. He had 2 of them at the time. And this gave him choices, right? It allowed him to relax, to look for the right position and the right job. And that's what we all need to do. We know we cannot depend on the government any longer. I mean, look, not too many decades ago, the whole mentality of society was that we're going to depend on the government for our Social Security, our safety net, right? And then it was, well, we're going to depend on the corporation. And those things have just gone out the window. They're completely gone. The economy is changing too quickly. The world is changing too quickly. And the only real security is the security we create for ourselves. So, empowered investors, that's what you're doing. Congratulations. Keep up the good work on that. Definitely. Now, Baselane, our sponsor. It is the #1 banking platform built for real estate investors. It's banking, online rent collection, bookkeeping, tax reporting, analytics, and more. You can enjoy real-time cash flow analytics on your properties. You can get ready for tax season with automated bookkeeping and financial statements ready for your CPA. Join more than 40,000 real estate investors who trust Baselane to manage their rental property finances. Go to baselane.com/Jason for a chance to win a $500 Amazon gift card. Oh, by the way, on these staff shortages, which lead to higher wages, right? Here, what's interesting also on this chart is the change in these companies' reporting from 2017. Okay, so in a 5-year period, or 5 years or so, give or take, look at how this has changed. In Japan, companies reported that things were getting a little better than they were back in 2017. But in Germany, worse. In all the other countries, India, UK, United States, China, Colombia, Finland, all of them reported an inferior or deteriorating market for employees. Shortages, shortages, shortages. And folks, this is a structural shortage because the baby boomers did not have enough children. Their children are now the prime working age, and their children are pretty over-entitled, okay? So that's another issue that we don't need to get into. But this shortage is likely to be just built into the economy for many, many years, and it means lots of inflationary pressure in the system. So good news for you investors. Okay, I thought this was interesting. We've got a big eclipse coming, and several of our markets are affected by this. And one of them, Indiana, declared a state of emergency because of the eclipse. Can you believe it? Well, why would it be a state of emergency? Well, I read about this in a few different articles. And one of them is that people have eclipse parties. And there are more drunk drivers because people are going to and from these eclipse parties, right? So are you going to an eclipse party? Maybe you are. Let us know how it goes. But look at the way this eclipse is panning out across several of our markets that we are either recommending now or have recommended over the years. Dallas, Little Rock, Indiana, Cleveland, right? Those markets are all markets we've done a lot of business in over the years, all very much affected by the eclipse. So I just thought that was an interesting news story that they would declare a state of emergency, traffic problems, all kinds of problems with this. So be careful out there, folks. Okay, I want to look at this study that just came out, and it's an ICE mortgage study. Now, this is a mortgage research and tech company that publishes this, and they got a lot of great data, and we have not talked about their data before. So let's just kind of go into it a little bit and evaluate what's going on with the mortgage market. Why does that matter? Well, it matters in a huge way because it gives us an indicator as to how people are feeling out there in terms of their mortgage, how likely they are to be in distress and end up having to sell their properties quickly, right? This is a predictor for where the market is going. What direction is the housing market going in? All right. So this is a first look at their mortgage performance report. Delinquencies improve, meaning they're down. So that's good, I guess. Depends on what side you're on. Like everything's good and bad depending on what you do and where you are and how you make your money, right? Okay. But most people would say that's good. And foreclosures drop as prepayments rise modestly. Okay. So People are paying off their loans early, modestly, a modest increase in that. And there are fewer delinquencies and fewer foreclosures. The national delinquency rate eased to 3.34% in February, down 4 basis points from the month before and 11 basis points from a year earlier. Okay, so improving conditions. While the number of borrowers one payment behind rose modestly by just 10,000, that's 10,000. Okay, so in a country where you have about 140 million housing units, we had a 10,000 person increase in people who are 30 days late on their mortgage. But those who are 60 days late, as well as those who are 90 days or more late, the people in serious default, right, or more past due, fell to their lowest levels in 3 months. So people are missing one payment, but they're not missing 2, 3, and 4 payments. Those people are fewer in number, right? So, it depends where they are on that delinquency spectrum. Delinquency inflows rose 6.5% from January's 8-month low, while rolls for later stages continued their recent improvement. Okay, so what does that mean? Inflows of delinquency. That means new delinquencies. Those are those 10,000 people we just talked about. Okay, so those increased by 6.5%, right? And it doesn't mean 6.5% are delinquent. That's just the increase amount. So it's a very small number, basically. And the later stage people improved their situation. They caught up with their mortgage. Okay. Serious delinquencies, loans 90 days or more past due, but not in active foreclosure, are down by 103,000. So 103,000 people improved their situation and caught up on their seriously delinquent mortgage. They were 90 days or more behind, and they somehow either they sold their property, they refinanced their property, or they just paid the lender, right? They reached into their bank account and they figured out a way to pay their lender and cure the delinquency. So that's great news, right? That's good for market prices continuing to rise as they have been. So those serious delinquencies are down by 18% year over year, with the population now standing at 459,000 people. So again, compared to what? Out of about 140 million housing units, 459,000 people are 90 days or more past due. Very small number, historically speaking. All right. Down 18%, as we just talked about in the other number. Okay. Representing 5.3% of serious delinquencies, February's 25,000 foreclosure starts. So this is someone who's at the starting of the foreclosure process. It doesn't mean they will end up getting foreclosed on. Most of them don't. Think of it just like a lawsuit, because essentially that's what a foreclosure is, right? Anybody who's familiar with litigation or has been in a car accident or whatever and had an insurance payout or is a lawyer, right? Everybody knows that the vast majority of lawsuits never see the inside of a courtroom, right? They never make it to trial. They simply litigate, and they end up settling. That's what happens most of the time. The same is true with foreclosures. Most foreclosures that start do not finish, right? They somehow cure the problem. Okay, so February's 25,000 foreclosure starts is the lowest in the last 12 months, showing improving conditions. The number of loans in active foreclosure fell by 7,000 to a total of 211,000. The remaining 25%, which is 72,000 below pre-pandemic levels. So you have to always throw out the pandemic because that was just a weird time, right? But in 2019, or before the pandemic, right, we have 72,000 fewer foreclosures, okay? So much lower than before. And just wrapping up here on this, 6,000 foreclosure sales were completed nationally in February, a 9% increase from the previous month and the second lowest level in the trailing 12-month period. Now, that gives you an indicator, right? Above, we talked about how they had 25,000 foreclosure starts in February, but 6,000 completed. So if that's normal, right? You see the numbers. The comparison is 25,000 start, only 6,000 complete. They actually go through the entire foreclosure process. Just again, folks, what we're talking about here in terms of distress in the market, the bottom line is it's a big nothing burger. There's like so little distress, it's just not even worth considering, right? It's just like a nothing burger. Okay. I kind of like that saying, nothing burger. Okay. So now let's talk about those prepayments, the people who are paying early. Okay. Prepayment activity rose by 3 basis points in February to a level not seen since October, as a brief dip in rates heading into the month provided a modest increase in refinance incentive. So more people refinancing because the rates went down slightly and they paid off their old loans. Okay, let's look at a couple of charts here that I've got on this. And this just kind of gives you some visual data, if you're watching on video, on mostly the stuff we've been talking about. Okay, and you can see that overall things are pretty much very, very good. They're very positive. There's just not a lot of distress. As I always have been saying to the Crash Bros, look, if you want me to change my opinion, show me some data. Don't just tell me, oh, the real estate market's going to crash because I'm a Crash Bro. Come on, idiots. Seriously, show us some data that shows us there's a lot of distress. Remember, as I've always said, the one thing you must have, the absolutely necessary ingredient that you must have for a real estate market crash is you must have millions of distressed homeowners who become millions of distressed home sellers. We have the complete opposite, low inventory, super low distress, and we have the cost of money that's almost tripled at the peak, right? And we have a Fed who's being so stingy that, we thought they were going to lower the rates by now. They just won't really lower the rates, right? They're just holding the course. And we know there's going to be a pivot, but it hasn't really happened yet to any significant degree. So it's amazing the market is this resilient. And this chart, home price index, the HPI, shows that overall price is up 5.7%. Okay, that's year over year, 5.7% nationally. Now, think about that. If you are leveraged and say you have 10% equity in the property, right? If you're at that point, that means your leveraged return on investment, the gross return on a leveraged basis, was 57%. 57%, not including tax benefits, positive cash flow, equity pay down, anything. That's just simple leverage depreciation. It doesn't include inflation-induced debt destruction. This is why income property is the most historically proven asset class in the entire world. Yay. It is the best thing going. Okay, here's the chart of the national delinquency rate of first lien mortgages. So again, you could have 2 mortgages on your property. You could have a first lien and a second mortgage, right? A HELOC or any kind of second mortgage. And this shows you that the average is about 4.54%. And right now, we are just above the record low for delinquency rate, just slightly above the record low, which happened last year, where it was the lowest delinquency rate in history. Okay, this chart goes back to 2003. Unbelievable. Just like show me some signs of distress, and then we'll talk about how the market's going to crash. It's just the complete opposite. All right, folks. So I hope that data was helpful to you. We want to get more into talking about techniques and so forth, but let me wrap up today by just talking a little bit about packaged commodities investing. And last night, we had a fantastic Empowered Investor Pro call. As you probably know, we do those once a month on the first Tuesday of every month. And we get our pro group members together. We jump on Zoom for about 90 minutes. And I talked a little bit about modern monetary theory last night. We talked a lot about very tactical stuff, very specific stuff about people dealing with their properties and, how to optimize everything they're doing, right? And answered a lot of questions. But the other thing I just wanted to expand on more that I talked about last night a little bit is my strategy of packaged commodities investing. And think about it. You are really a commodities investor when you invest in real estate because you're buying those 2 components. You're buying the land and you're buying the structure or the house sitting on the land. And what are the ingredients of that house, of that structure? Well, they are what I've said before, right? They are concrete that's under your feet, flooring materials, drywall, copper wire in the walls, glass, steel, energy, petroleum products, labor. All of these things have intrinsic value. It doesn't matter what the dollar is doing, or the euro is doing, or the yen is doing, or the Brazilian real, or the Russian ruble. It doesn't matter. Everybody in the world needs these same packaged commodities because they are the ingredients of one of the three fundamental needs every person has: food, clothing, and shelter, right? So when you own those commodities, you are a packaged commodities investor or an assembled commodities investor because they are the ingredients of your houses or whatever, right? Your real estate deals. But if you went to the commodities exchange to buy these things, you could buy them there and you could invest in them directly. But the problem is you wouldn't get a 30-year fixed rate mortgage on them. You wouldn't get inflation-induced debt destruction. You wouldn't get special tax benefits. You wouldn't be able to rent them out to somebody else. When something has the real estate label on it, it acquires all of these incredible special characteristics. I mean, think of it. People are just people, right? So you look at King Charles, who used to be Prince Charles, right? He's just a goofy person, okay, with big funny ears, right? I got to meet Prince Charles once when he was Prince a long time ago at a opening in Century City for a film. He's just a person, right? But what makes him a big deal? His label, his title. President Biden, he's just an idiot. Oh, I mean, he's just a person. What makes him a big deal? His label, his title, right? President Trump, right? Same thing. What makes him a big deal? Well, with him, you could actually say he's accomplished a lot of stuff, right? He hasn't been on the dole working for the government all his life like Biden. But I know that half of the people in the country hate Donald Trump, so I'm not going to bring it up. But my point is, love him or hate him, right? He definitely has accomplished a lot. And he got the title of CEO, businessman, real estate investor, all of this stuff, right? Whether you love him or you hate him or you think his business dealings were legit or not, it doesn't matter. The fact is he acquired the title. But then he acquired the title of President of the United States. He's just a person, okay, with certainly has a lot of flaws, right? We've all seen that, okay? Everybody's just a person. But what gives them all sorts of privileges and rights? Their title, their label, okay? So you take all these ingredients, right? I'm in my house now here in Palm Beach, Florida, and you look behind me and you see walls and they're made of drywall. And inside the drywall, there's 2x4s and there's bricks because it's Florida and every house is built with, like this house is built like a tank. Okay. There's copper wire in the walls, right? There's insulation around that copper wire that's made from petroleum products, right? Oil. So all of these packaged commodities I own, but they have a new special label because they're packaged together and they're called real estate. And when they get that label, just like getting the label of President of the United States, they get all sorts of special privileges, tax benefits, inflation-induced debt destruction, leverage, the most debt-favored asset class in America, the best loans, the best lending. And that's why income property is so incredible. There are other reasons it's so incredible too, but those are some of them. All right, so hope that's helpful. Think of it that way. Remember, on Wednesday, 1 week from today, we have our second Wednesday of the month, monthly Zoom meeting. And this is totally free, no obligation. Come and join us. We are going to have our expert, Scott, talk about how to fire your property managers, how to set up your properties on lease option and rent to own deals. I tell you, I've done a lot of stuff in my career, but recently implementing these strategies for myself, for my own portfolio, has been one of the most lucrative things I have ever done in real estate. I mean, it's just been incredible. And I'm going to tell you something else that I'm going to talk about Wednesday. I started with offering lease options to my tenants, and I did not do a single deal, but I still made a fortune with this strategy. And I'm going to tell you about it on Wednesday at our Zoom meeting. Just go to jasonhartman.com/Wednesday. That's easy. jasonhartman.com/Wednesday. Register for that. It's totally free. We'll meet for about an hour, hour and a half, and we'll share a bunch of great techniques for you. And I think you'll really, really enjoy this. Whether you end up doing a strategy or not, totally fine, but it is an incredible strategy. We've got our expert, and I and our investment counseling team will be there on Zoom to answer your questions and go over some great techniques for you. Also, we still have that one cabin, just one cabin on our sold out Empowered Investor Cruise that is actually sold, but it's coming back on the market because one of our team members who reserved that cabin cannot attend. This is a veranda cabin and it is available. Several people have expressed interest in it, but until they put up the money, nobody's got it. Okay. So first come, first served. Go to empoweredinvestorlive.com. That's one of our live events, obviously, the cruise. And it's at the end of this month on the beautiful brand new Celebrity Apex cruise ship. It's going to be a great time. Go to empoweredinvestorlive.com if you want to snag that one last cabin that came back on the market. And it is a veranda cabin. You don't have a choice. You can't get an inside cabin. We just have one. It's a veranda, so it's got the balcony and all of that stuff. All right. Until next time, happy investing. We'll look forward to seeing you on Wednesday live on our Zoom meeting, jasonhartman.com/Wednesday. We will see you there.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.